ezikulaakulanyize mu Uganda. Uganda is rich in natural resources and hard-working people. But to turn these resources into real progress and development, we need to invest in our infrastructure, education, and healthcare. That's where taxes come in. When we pay our taxes, we are investing in our country's future. We are supporting the schools that educate our children, the hospitals that care for our families, and the roads and bridges that connect our communities. And when businesses pay their taxes, they are contributing to the growth and development of Uganda's economy. They are helping to build.
Good morning and welcome to this episode of Tax Mchuzi, where we shall continue or we shall resume discussing pay-as-you-earn compliance guidelines for employers. My name is Josephine Kabiasiza, and I'll also allow our guest today to introduce herself.
Good morning to you all our viewers, and thank you for tuning in to URA and getting the tidbits of tax education for this week. My name is Jolly Mutesi and I work with Domestic Taxes Department in the URA.
All right, thank you for joining us, Jolie. So what happened last time is we talked about pay-as-you-earn, the different rates and other different aspects. Then we had a host of questions, and I thought maybe we could dive straight into those questions.
Okay.
But maybe before we can go into that, can you give us just like an intro
to pay-as-you-earn?
Yes.
Okay. So pay-as-you-earn is basically an income tax, but it was given the name pay-as-you-earn because of where that it's collected, being that it is collected from employees and it's collected by employers at the point when they're paying salaries or wages to their employees. So income tax is ordinarily supposed to be a yearly tax that is paid by individuals every end of the year. But because we know that it would be difficult for Josephine to be given her salary and then she keeps the tax and pays it at the end of the year, which would be at the end of 30th June, it became prudent that the law allows for, first of all, the employer to be the one to withhold this tax and pay it for you so that you don't have the burden of paying it yourself. And then secondly, it is done every month. So it is done in manageable installments, and it is done in a way, of course, that also gives government operating, because imagine if government had to wait for tax to be paid at the end of the year, how would we operate? So in the meantime, you pay a little bit every month, and then government continues to operate, and it also makes it easier for the employees who are being taxed to pay this money in small bits than wait until the end of the year and pay a big lump sum. So it is an income tax. It is the way that it's collected that gives it the name pay-as-you-earn. So as you earn it, you pay it, and it is supposed to be paid by the employer because they have the obligation to withhold it from their employees and pay it every month.
All right. Thank you. I think that's very, very clear. So as promised, I think we can start with our
questions. Yes.
So we had some questions to do with stamp duty on employee contracts.
Okay.
So you can maybe talk a bit about that and who pays it.
Okay, so stamp duty is what we would call a non-tax revenue. Okay, it's not a tax in and of itself, but it's a duty that we pay, or a sort of government levy for the purposes of legalizing particular transactions that are listed in the Stamp Duty Act. So one of the things we legalize is documents or agreements that are entered into between persons, so that at a point in time where maybe there are any sort of disagreements, it is easier for us to take these documents to be interpreted by the court. So for that to happen, then the document must have paid a duty, or what we call stamp duty for circumstances. So all agreements are subject to stamp duty, and the rate is 15,000. It is the person who takes benefit from the particular agreement that has the obligation to pay the stamp duty. So URA has not been very keen on collecting these particular stamp duties, especially because sometimes they won't even know when everyone in Uganda enters into an agreement. So I know that when we stepped up our compliance and stepped up our enforcement, some people were caught unawares or shocked. But this has always existed. It's not new. The Stamp Duty Act is very clear on which agreements are subject to stamp duty, and an employment agreement is an agreement like any other, and it will be subject to stamp duty. This duty is paid by the employee because they're taking benefit from the agreement. But of course, when it comes to compliance, URA will come and ask the employer, how many agreements do you have? Have these paid stamp duty? So it is just a duty or levy that is paid on agreements, which includes employment agreements, and it's a flat rate of 15,000. And it's paid once, it's not monthly. You pay it once when you enter the agreement, and that is it.
Okay.
Yes.
And then we had a couple of questions to do with casual laborers.
Yes, casual laborers.
In the sense that some of them are paid on a daily basis as opposed to monthly.
Yes.
Because we seem to talk about the rates in terms of monthly or annual terms.
Yes.
Then we also had some questions to do with the fact that some casual laborers are not the same. Today it's Julie, tomorrow it's Josephine, another day it's Paul. So they were wondering about pay as you earn with regard to casual laborers.
Yes. So one thing we should note is that the law that provides for employment income in our tax laws, or what we'd call our Income Tax Act, provides for what amounts to employment income, and that includes salaries, wages. And if you look at casual laborers, most of the time they're paid a wage, which may be a daily wage, a weekly wage at the end of every week. Now, for as long as that person is your employee, then you as the person that is employing them has the obligation to remit pay as you earn, or to withhold from the money that you're paying them and pay tax to the URA. So maybe the first thing that we need to answer is, who is an employee? Okay, is a casual laborer an employee? And the determinant of whether someone is an employee or what we'd call independent contractors, because if you're not an employee, it automatically means you're an independent contractor. Now, the determinant of who is an employee and who is an independent contractor then drills down to what exact arrangement you have with this person. So one, do you have an employment contract with them? Okay, it states down their roles and their obligations. That person would be an employee, but we know that there's some people who don't have contracts. I mean, sometimes if you get a builder, are you going to give them an employment contract? Most likely not. Then do you pay them a determined wage or a determined salary in a determined period? Do you direct them on how to do their work? Do you give them tools of work? Do you determine the hours that they're supposed to be at work? For as long as you have that much control over how someone does their work, then that person is an employee, whether there's an agreement to that effect or not. Just like Josephine, you come to work because you are supposed to be here 8 to 5. Okay, even if you come and you're on your computer and you're not necessarily doing the work, but you're supposed to be here between 8 to 5 unless you're in the field or sent by the employer to do something. So they determine your working hours. They give you a salary at the end of the month, or even at the end of a week or 2 weeks, whichever period they decide to pay it. They give you the tools of work, computer, pens, pencils, books, whatever you need to work. They determine how you should work. That basically makes you an employee. However, if you are the kind of person who is given a job to do, okay, you're told, make sure this building is up in 6 months. You're not told how to do it, because most likely you're specialized, you know how to do it. You're not told when to do it. You're not given tools. You come with your own tools. You know, you determine your own working hours because you're good at this, you're a specialist at this. You determine when to work and when not to work, as long as by 6 months the project is completed. Then that makes you an independent contractor, because the person giving you the job does not control you in any way. So those are the two differences. So for as long as we understand who is an employee and who is an independent contractor, then that is when we understand the obligation to pay as you earn. For as long as someone is your employee, whether they work once a day because that's what you, whether once a week because that's what you have agreed with them, whether they work every day of the week, whether they work 1 week in a month, but that is what you've agreed with them. And during that period, they're doing exactly what you tell them to do using your tools, then that person is subject to pay as you earn. If someone is an independent contractor, you don't determine how they work. You just give them a contract to deliver something in a given period and you leave them at it. Then that person is an independent contractor, and what you do is withhold 6% on their fee because they are not your employee. So employment and pay as you earn are intertwined. As long as they're employee, then it's subject to pay as you earn, regardless of how many days they work, regardless of how often you pay them, whether it's once a week or once a month. For as long as you control them and how they do their work, and you pay them a determined wage or determined salary, they're your employee and therefore subject to pay as you earn. Then the last part you asked is, what if you have Jolly today for 2 weeks, then you have Josephine for 2 weeks. Pay as you earn is an income tax, so it is paid by each individual. Jolly pays her own tax, Josephine pays their own tax. It is not the employer to say at the end of the month, who did I have, and I add up everything I paid and pay as you earn. No, it is Jolly and Josephine that are paying the tax. You as the employer are simply withholding it from their pay because you have the obligation to do so, and paying it over to URA, because URA knows if you give it to Jolly, she might not pay it, okay? Or she might use it for other things and then URA never receives it. So that is why it is more efficient that the employer is the one who withholds it. But you, the employer, are not the one paying it. You're just simply collecting it on behalf of URA, like some sort of agent. The person paying it is Jolly and Josephine. So whether Jolly works for 2 weeks, Josephine works for the other 2 weeks in the month, for as long as the payment you give them exceeds their threshold, and for as long as they are your employees, as we've discussed, then you are supposed to withhold the pay as you earn and pay it over to URA in that month.
Okay. So I think in answering that question and talking about independent contractors,
Yes.
or comparing them to employees,
yes.
You've also kind of preempted or tapped into the other questions that were there, some to do with part-time staff,
Yes.
or external resources, or special teachers or talent maybe,
Yes.
that's outsourced.
Yes.
And some of the questions were in the medical sense.
Yes.
I think like radiologists, some of these things are hard for me to say, like anesthesia. The guys who apply anesthesia.
Yes.
Oh, we help people with that.
Mm.
But I'm not a medical person, but I hope people understand.
Yes.
And then there was also the schools.
Yes.
A couple of them sent through questions asking that schools sometimes solicit services of external resources,
Yes.
such as teachers or examiners. Maybe those teachers are knowledgeable in a particular subject.
Yes.
So maybe you call them in at certain times to teach your school, even though they may be teaching another school.
Yes.
And so I don't know if you want to make an additional comment in regard to such scenarios and pay as you earn.
Yes. So like I mentioned earlier, do you direct and control how they do their work? That is what differentiates between an employee and an independent contractor. Okay? For as long as you direct, control how they do their work, determine their working hours, give them tools of work, or of course have an employment contract with them, they're an employee. If you don't determine how they do their work, don't determine the hours within which they do it, don't determine the tools that they use for their work, and they just come in with their own tools, their own knowledge, and tell you, okay, I will give you 2 hours of my time on this day, that's an independent contractor. So the line can be quite thin, and it can depend on the facts and circumstances. So it is very important that you as the employer can factually determine who is your employee and who is an independent contractor. Because let's say you have a teacher, okay, and this teacher is good at economics. You're a private school. You know that this teacher who teaches in Chitende is very good at economics. I will need him to come and teach. And the teacher comes and tells you, okay, I can only give you my Saturdays, and I'll come for only 2 hours, and I'll teach you S5 or S6 class for these 2 hours, and I want this much for my work. That's not your employee. That's an independent contractor. They've determined when they can give you their time, how much time they can give you, and they're going to come with their own knowledge, okay? And you are just going to pay them for those 2 hours that they're going to teach you S6 class, maybe preparing them for your NEB exams. That is an independent contractor. But if you enter into an agreement and tell this teacher, I need you to work here every Saturday for 2 hours, and I'm going to pay you 50,000 or 100,000 per hour. You're supposed to work during this particular time, maybe from 10 to midday. You're supposed to teach this particular subject. I'm giving you the class, I'm giving you the textbook. You'll use my chalk. You come and teach these particular students for this particular period of time. Then that is your employee. Okay, so the line can be quite thin, but it is very important that employers determine who is an employee and who is an independent contractor and set out the terms and conditions clearly so that they're able to determine, do I withhold pay as you earn and remit it to URA, or do I then just pay the person and withhold 6% for their services? If this is continuous, every Saturday the teacher is there, then most likely they're an employee. And you probably just don't want to say that to URA because, of course, the rates of pay as you earn are much higher than the 6%. But if this person just comes in maybe for just the last 2 months or the last month just to pay you for your NEB exams, then you can clearly see that that is an independent contractor.
Okay. So maybe to digress a bit, not digress, but as an addition,
Yes.
after you've taken 6%, after the school,
Yes.
Jojo's Academy has
Yes.
taken away 6% from Jolly's pay,
Yes.
how does Jolly or that independent contractor, how do they handle the rest? Do they just do 6%? Shouldn't we all be
Independent contractors? And no, we can't all be independent contractors. So like I mentioned, all individuals, okay, that earn income from Uganda have rates that they're supposed to pay. And this depends on whether you earn from business or you earn from employment or you earn from property, okay, not rent, property. So you have individual rates that apply to individuals that earn income in Uganda. The only reason why we call this one pay as you earn is because of the way that we collect it. And the only reason why we do it monthly is to make it efficient. But all of you as individuals who are working in Uganda, earning income from Uganda, you're subject to the same rates. Now, if you, Josephine, come and offer your independent services, an independent contractor, and the school withholds 6%, URA will know that Josephine earned from the school maybe 5 million, maybe 2 million, and the school withheld 6%. URA will expect Josephine at the end of the year to file a return for the entire amount that they earned, show the rate that they were supposed to pay according to the individual income tax rates, and then show the tax that they were supposed to pay. The 6% was just an advance, okay? So you will just pay less the 6%, but you will have to pay the balance. So let's imagine that in the whole year, that is the only job you had. So let's say you earned 10 million in a school, they deducted 6% of 10 million and gave it to URA. 6% of 10 million would be about 600,000, yes? So you earn 10 million. So we'll go back to the individual rates and see where do you lie. Okay, if you earn 10 million in a year, how much tax would you be subject to? And once we determine that, the 600,000 would just be an advance and you'd pay any balance, if there is any to be paid. If you are in a rate that charges you 30% in a whole year, then the 6% would simply be an advance. You'd be expected to pay the balance after we've applied a rate of 30%. And because the school has declared you in the withholding tax return, it is easy for us to track you down and know that you actually earned this money. So that makes it easier for you to know who earned, because we shall look at the withholding tax returns and know that this person earned from this school. They simply deducted 6%. I will go back for the balance. This is not just for employees, even companies. When companies supply government entities, they supply different various big businesses, they deduct 6% on their payment. But companies have a rate of 30% tax in a year. So that 6% is simply an advance. Like I said, we pay tax in advance because government needs to operate. Government is not going to stop and wait until the end of the year. So we need to operate. So those advance payments are necessary to keep the wheels of government running. But at the end of the year, we shall go back to that company and say, okay, you earned 10 million here, 20 here, you supplied goods here, they gave you 50, total you earned 100. When we remove expenses, your profit was 10 million in the year. You're supposed to pay 30% of 10 million, which is 3 million. But from these different supplies, deducted 6%. Maybe if the 6% added up together is 2 million, then you pay the balance of 1 million. So the 6% is simply an advance. It's not your final tax. That's why all of us can't pay 6% because it's simply an advance. And at the end of the year, URA will come for its balance.
Okay, thank you for that. And I think that has also touched on the bit of how to classify that an individual is liable for pay as you earn,
yes,
or withholding tax.
Yes.
Maybe before we go to the next question, is 6% for all residents and non-residents, or is it a blanket?
Okay, so 6% withholding tax only applies to residents. For as long as you decide to get a non-resident person to provide you with any sort of services and they're not your employee, then the withholding tax rate becomes 15%. If we have a double tax agreement, of course that will change, but let's not go into double tax agreements at this point in time. But the rate will be 15%. If the person is not resident in Uganda, they fly in, just do this work and go back, then they're supposed to have a withholding of 15% of their gross payment. So 6% only applies to residents.
Okay. Then I know you've seen there were so many questions about teachers. I think that they had a
Yes.
lot of people
A lot
who
of
run
teachers,
schools or
yes.
teachers or who account for teachers and
Yes.
schools. And so someone was asking if schools pay income tax.
Do schools pay income tax? That's a very good question. So schools are businesses, okay? Especially private schools. They're businesses just like any other business. People pay school fees, and the ultimate aim of the proprietor of the school is to make a profit. And schools are quite profitable these days. So private schools, yes, private schools are supposed to pay income tax because they're profit-making businesses. The only schools that would probably not pay income tax are schools that are set up for charitable purposes. You know, some schools are set up by foundations for purposes of just doing charity. They just charge bare minimum to keep the children in school. They're not set out to make a profit. But if you have set up such an institution, it's not profit-making, and you simply want to help maybe disadvantaged or marginalized persons, then you are meant to apply for an exemption from URA. They will come in, inspect your business, confirm that indeed it's not profit-making, and indeed this is set up for charity purposes, and for that particular entity or institution, they will give it an exemption. But otherwise, private schools that are set up for purposes of making profit have to pay income tax.
All right. And then there's a question about public servants.
Yes.
Do public servants, such as those in local government, pay as you earn?
So yes, pay as you earn is an income tax. Okay, the name pay as you earn should never confuse us. It is an income tax, and yes, for as long as you're employed, whether you're employed in public service or you're employed in private, you are supposed to pay tax because you're a citizen of Uganda. It is your noble duty to contribute to the development of this country through payment of taxes. Now, what happens is that there are just a category of people whose employment income or whose benefits are exempt from taxation, and that includes our security forces that are trying their best to keep our country safe and secure. That is the UPDF, as well as the Uganda Police Force, as well as the prison service. So in the law, those particular persons' income is exempt. So if you are employed in the UPDF, Uganda Police Force, prison service, the employment income that you earn or the salary that you earn for the work that you do is exempt. Those are the only people that are exempt, or whose employment income or whose salaries are exempt from tax. All of us have to pay tax, whether you're in public service or private companies or organizations. Your salary or your employment income is subject to tax. So yes, public servants pay tax. URA employees pay tax. People out there sometimes think we don't pay tax and say, maybe these people don't even pay tax, and they come and want to shut down our shops and all. But everyone is supposed to pay tax.
Yeah.
Okay.
Okay, I actually get that a lot, that people think we don't pay tax. I wish they knew. So, can I claim deductions or reliefs on
Yes.
pay as you earn, and how do I apply?
Okay, deductions or reliefs from pay as you earn. So, like I mentioned, pay as you earn is a yearly income tax that is only broken down into monthly payments to make it more efficient, to keep the wheels of government running. Now, there might be some instances where, because of probably a few increases in the person's salary coming out of allowances here and there, the person ends up paying a little bit more when you add up the income that they've earned in a whole year and what they've been subjected to every month. For example, let's say you've earned, 9 million or 8 million every month. And then in 1 month, they give you an allowance, or in 2 months, they give you an allowance that hits up your salary to 10 million. That will put you in a different bracket for that month. But when we go at the end of the month and add up all the money that you've earned, you might still have remained in the same bracket of 30%. So yes, in that month, you went up to the 11 million, so you exceeded 10 million for that month. But when we add up, you actually did not reach over 120 million. So meaning you paid a little bit extra than you should have paid. Or when persons who are employed import things for personal use, let's say a car, you import a car into the country, but you're employed, and then they make you pay 6% at customs, 6% withholding tax. But your only income is employment income, meaning by paying that 6%, you've paid a little bit extra tax in that particular year. So for such persons where you've paid a little bit more than you should have paid in a year, when you add up all your tax that you've paid and your income for that year, and it's purely employment, you can ask for a refund. Okay, it's very few instances, but when that happens, you can ask for a refund, and that is the only relief that we can give to such persons. Otherwise, can you ask to be exempt from income tax when you work a normal job? You're not in the security forces. Unfortunately, no, because we all have to contribute to the development of our country. So reliefs in terms of I don't want to pay this month, or can I not pay for 1 or 2 months? No, we don't have such reliefs. But where you overpay because of one circumstances or another out of your bracket, then you can be entitled to a refund at the end of the year, because that's when we know exactly how much you have earned and how much you should have paid and where the overpayment came from.
Okay. And how do I apply?
Okay, it's simple. It's on the portal. You just log into your account on the portal and you apply for a refund. Of course, you have to attach your evidence to show that you overpaid for that particular year, and you are able to refund the money back to your bank account.
Okay. Then there were a couple of questions about when to file.
Okay.
And pay.
Okay.
Can I register and pay before filing a return?
Yes.
Which one comes first, payments or returns?
Okay.
Some of us want to pay in the month where it has been deducted, but the returns only allow us to do that after that specific month has ended.
Okay.
What are your comments on that?
So our procedures and our tax procedures provide that we are supposed to file the returns and pay the tax by the 15th day following the end of the month in which the tax was withheld. So for example, if I am paying pay as you earn for the month of July, I have to pay it by 15th August. That's about next week. So by next week, I should have paid, by 15th, I should have paid the payee for July. So why is it that then the return only allows us to start filing from 1st? Because some people pay on 31st. Okay, so some people paid salaries on 31st July. How is that person going to file a return for July in July when they've not yet paid? Because remember, it's a withholding tax. When you're paying the salary, you withhold. So if you paid on 31st July, when are you going to file the return if you withheld on 31st July? So that is why whether you pay your employees on 1st July, on 15th July, on 20th, 22nd, or 31st, all of you start filing on the 1st, because different businesses have different payment dates. So the system is triggered in such a way that it is after the last day of the month, when we are sure everyone has paid whoever they're supposed to pay, that now the system triggers you to file a return. So you can only start filing for the return of July on 1st August. Now, the law says you should have filed and paid by 15th. So it gives you a period of 2 weeks within which to organize yourself. You can file and pay on the 1st, 2nd, 3rd, or even on the 15th, but at least by the 15th of August, you should have filed your return for July. Can you pay before filing? Certainly, yes, you can pay before filing. You can pay on 1st August for your July, and you file on 15th. Okay, the earlier the payment, the better. Please, it is better that you pay before filing than file before paying. Okay, but yes, as long as everything is done by the 15th, the payment and the filing. So you can pay on 1st and file on 15th, that's fine. But you cannot file on the 10th of July for July, because at that point in time, some entities have not yet paid salaries. And it's very rare that people are paying on 10th July, maybe 20th and going forward. So that is why you cannot file in the same month where we withheld.
Okay. So I'd like to tie in the question on claiming an accidental payment.
Yes.
How does one claim for money remitted to URA by mistake if a staff has already left as paying?
Okay.
Why I'm tying it in is because what I understand is we file returns so that maybe we can know what we should be paying.
Yes.
And maybe avoid accidental payments of people who have left. But as the expert, you can make a comment on that.
Okay. I'm seeing that question coming from someone who does what we call copy paste. Okay. So, when you file a return, you can't download the return for last month and just edit it and submit for this month, especially if your payroll doesn't change. It makes it easier that if I have the same employees January, February, March, April, instead of filling a fresh form every month, I simply download my January return and just change the dates and submit it. Now, unfortunately, if an employee left and you forgot the chances that yes, you're going to do the same copy paste template, change dates, and submit without removing that person, only to find out later that, oh, I shouldn't have added this person because they left and they were not paid for this month. So yes, if you happen to be those people, and there are many, because it's convenient, let's admit. So I'm not saying you shouldn't do it, but you have to be a little bit more careful not to make the mistakes. But if this happens, then the solution is that you can go back and amend that return, okay, to make it correct, or to correct the error that you made. So you can amend that return and remove that person that you forgot to remove because they left the company. And of course, if you've overpaid, then that amount might remain as a credit on your account or on your ledger, so that in the next month you can use it to offset your payment. Or if you really need to, you can apply for a refund to URA and say, oh, I overpaid PAYE by mistake because I did not withhold this money. This person was not working in the company by that time. Mistakenly, I paid it. You can apply for a refund, of course, with evidence that that person was not working in your company at the time.
Okay.
Yes.
Now, there's another hot topic.
Yes.
Called secondary employment.
Employees. Yes.
Couple of questions came through, but just to summarize, people wanted to know if I have my primary salary at 10 million,
Yes.
but the secondary employer also gives me something maybe 10 million and above. How do I handle that? What are the rates?
Yes.
Yeah. So maybe you can also first talk about what we refer to when we
as secondary
talk about
employment.
secondary employment.
Yes. Thank you for that. And I think that's an area of the law that is still very grey for many. It was quite the debate in 2022 when URA first issued guidance on it. And I believe that up to now, there's still some people out there that are still confused about secondary employment. So what do we call secondary employment? Secondary employment happens when you have more than one employer. Okay, especially this is very common in the education sector. I think that's why you had a lot of questions coming in from that particular sector, because you'll have especially university professors working for more than one university because they're working hours. Okay, you're not going to teach every day all the time. You have teaching sessions on different days of the week at different times. So it's possible for a university professor to teach in two different universities for as long as they have different working hours for both. So yes, it means that at any particular point, if you have more than one employer, then you have a primary employer and all the others after that are secondary. So if you teach at Makerere and you teach at UCU, it means one of them is your primary employer and the other one is secondary. Now, why is it very important for us to make that differentiation? If you look at our tax rates, there is what we call a threshold, okay? Now, in Parliament's wisdom, every Ugandan needs at least 235,000 per month to survive, basic minimum. Okay, so if you add that to 12 months, then that is what you need in a year. But on a monthly basis, 235,000 is what every Ugandan needs to survive. So 235,000 is not taxed. We start taxing anything above 235,000 in a month. So that is what we call the threshold. That above this threshold is when we start taxing you. But if you earn below this threshold, government is not going to tax you. Now, if you're earning from two different employers, both of them might give you this threshold. So meaning you've got 235 times 2. That is not the threshold. The threshold is 235, not 235 times 2. So the reason why we need to differentiate secondary employment is because we do not want people to earn from the threshold or to benefit from the threshold twice. So that when you have a primary employment, the primary employer is the one going to give you the 235. And then they tax everything after that. Then the secondary employer or your other employer will just tax everything without deducting the threshold. So that's the difference between primary employment and secondary employment. That your primary employer will give you a threshold, while the secondary should just tax you at a fixed rate depending on the bracket in which you fall. So like we mentioned in the first webinar, there were rates, okay, between 235 to 0 to 235, nil. Okay, then between 235 to 335, 10%. 335 to 445, 20%. Then above that, 30%. Now, depending on how much more the secondary employer gives you, it will determine the band under which you fall, and we tax at a flat rate without giving you that particular threshold benefit. Okay, so that's the difference between primary employer and secondary employer. Now, the problem I think comes from where this particular secondary employer gives you more than 10 million. because I know that that is the debate that was raging around. If your primary employer is giving you maybe 12 million and the secondary employer is also giving you 15 million, okay, because you are a university professor, you're very good, you have a PhD, so they appreciate your services. So everyone is paying you above 10 million. So what is the rate then that we use for each of these? The primary employer who is giving you 12 million will give you the threshold of 235,000. And of course, because you fall in the bracket, that is the last bracket, they will tax the balance at 30%. And then the extra that exceeds 10 million, they'll tax it an extra 10%, or what people like to call the 40%. But it is 30% and then the extra 10%. Now, the secondary employer who gives you your 15 million is going to tax at 40% flat rate. Why? Because you've already benefited from a threshold, so they shouldn't be able to give you that threshold. And here they will just tax at a fixed rate for that particular bracket. So that is the difference between these particular two employments. And I think that is something that needs to come out clearly, that secondary employers tax on a fixed rate the entire amount that they give you, depending on the bands on which you fall.
Okay. I think those who are viewing can see the different thresholds. Maybe before we go ahead, can you make a comment about the rates for locals and the rates for foreigners?
Oh, you mean residents and non-residents?
Yes. That's the language in which the message came.
Yes, yes.
But yeah, there's residents and non-residents. So maybe you can make a comment about each and then talk about the rates.
So maybe if I even make a comment about that, because there's this thing where people say locals and non-locals. You know, in our local speak, we'll understand that to mean foreigners, maybe non-Ugandans are not locals, and then Ugandans are locals. But when it comes to tax, we don't have that sort of differentiation. We don't say Ugandans and non-Ugandans, okay? What matters in tax is whether you're resident or non-resident. It has nothing to do with your citizenship or your color of your skin or anything like that. It's either you are resident or you are non-resident. You're resident if you're staying in Uganda, you have a permanent home in Uganda, and you stay in Uganda for more than 183 days. That is 6 months, basically. Whether you're Ugandan or not Ugandan, for as long as you stay in Uganda, you have a permanent home in Uganda, and you've lived in Uganda for more than 6 months in a particular financial year, you are a resident, regardless of where you come from. So our rates are between residents and non-residents. So I don't want people to have this idea that, oh, we tax Ugandans much more than foreigners. No. Tax is dependent on whether you're resident or non-resident, wherever you come from, whatever your citizenship. Now, non-residents are basically people that are not in Uganda for more than 6 months. I come to Uganda 3 months, do a particular thing where I'm employed for only 3 months, and I go back to wherever I came from. I might even be Ugandan, okay? And I come to Uganda, maybe I'm Ugandan. Yes, I am not in Uganda for the entire period. I'm in Uganda for part of the year. I'm in the UK for another part of the year. I'm in another country for another part of the year, but I'm Ugandan. So for as long as I am not in Uganda for 6 months in a particular financial year, or I don't have a permanent home in Uganda, then I'm non-resident for tax purposes. So that is why there's a different rate for residents and non-residents. And why? Another reason why we have different rates for residents and non-residents is because most of the time you'll find that that non-resident is also being taxed in the other country where they're coming from. I may be non-resident in Uganda, but I find myself resident in another country. For example, in America, it doesn't matter. They don't talk about resident and non-resident. For as long as you're a citizen, you have to pay tax. So imagine a scenario where I'm resident in Uganda, I'm citizen in America. I'm going to pay tax twice, okay? Or imagine a scenario where I'm in Uganda for 3 months, but the entire rest of the year I'm in the UK. And UK has the same rules as Uganda. So it means that for more than 6 months, I'm in the UK. For only 3 months, I'm in Uganda, meaning I'm resident in the UK. The UK is going to tax me on all my income. Because if it was reverse and I'm in Uganda for all the year, I'm not in the UK for 3 months, Uganda is going to tax me on all my income, whether from the UK or Uganda, because I'm resident in Uganda. So that is the reason why the rates are different, because you might find that this non-resident is being taxed in those other countries where they are at that point in time or where they are resident. So that is the reason why the rates differ. So 35,000 and less, a non-resident is paying 10%. Remember, for a resident, we say 235,000, zero. But for a non-resident, we're saying 10%. Okay, so that's a difference. Why? You find that in the long run, a resident is paying a little bit more than a non-resident because they're not here. They're only here for a short time and they go away. So if you look at it from the how much the resident is paying and the non-resident is paying a little bit more. Because the non-resident, if you earn 335, we shall first remove the threshold. The balance would be just a little amount of money and we tax it at 10%. So what you're paying is really small. The non-resident, 335, no threshold, we just start taxing. So it is important for us to understand that difference, because I noticed the sentiments was we're taxing Ugandans more than other foreigners. No, that's not true. If anything, they're paying much more.
Okay. Before we leave the rate still, there are some questions about that extra tax of 40%.
Yes.
So some people think that when a person earns above 10 million in a month,
yes,
they pay an extra 40%.
Yes.
So I think you need to also talk about how, for lack of a better word, how the rates are applied to the chargeable income when you're calculating.
Yes.
Yeah.
So the rates for residents, because that would be rates for residents. Now, if you can put up the rates for residents, and then we can explain the rates much more. Okay, so those are the resident rates. So these rates are based on income that is being earned on a monthly basis, though in the law you'll also have the yearly basis, but since we're talking about employment income, this is usually on a monthly basis. Now, for a resident taxpayer, you're resident in Uganda, regardless of your nationality, if you earn between 0 to 235,000, then you pay nothing, because like I said, it's the bare minimum or basic minimum that you need to survive, as determined by Parliament. I know people will have sentiments. Is that enough? They can't even pay rent. But that is what was determined by Parliament. And if we need that to change, we'll probably need to lobby our parliamentarians to increase that threshold to a much more realistic figure, because it's been quite a while. But for now, that is what we have in the law. Now, if you exceed 235,000, okay, but you do not exceed 335,000. So your salary ranges between 235 to 335. First of all, you will get the 235, okay, your threshold. Then anything else that you earn more than 235 will be taxed at 10%, for as long as you do not exceed 335. If you exceed 335, then that is not your band. So you don't even look at that one. You go to the next band, the band of people between 335 to 410,000. Okay, so your salary per month is between 335 to 410,000. Again, you first remove the 235 and then you pay 20% plus 10,000 Uganda shillings. Okay, the next band is for those that now exceed 410 but do not exceed 10 million. I know it's very wide, and people say, really, how do you put the 410 and the 10 million in the same band? Again, please go to Parliament and lobby for that to be changed. URA cannot change that. That is a law that was handed down to us, and that is what we use. So again, in that particular bracket, you first remove the basic minimum and then apply a 30% plus 25,000 Uganda shillings. Now, if you exceed 10 million Uganda shillings per month, you earn 12, 20, 15, 40, I mean, they probably even earn 100 million in a month. If you exceed 10 million, okay, let's say you earn 15 million, we're going to first, of course, remove the threshold that you need, and then we get the entire balance and tax it at 30%, okay? And then the extra that exceeds 10 million, let's say the extra 5 or the extra 10 if you earn 20, is what is taxed at an extra 10%. So in that point, people call it the 40% bracket, because you've exceeded 10 million and they first taxed your entire amount at 30%, and then whatever exceeds 10 million is taxed at an extra 10%, and people call it the 40% bracket, but it's not entirely a 40% bracket, unless this is your secondary employment. If it's your secondary employment, then we don't even talk about thresholds. We simply get your 15 million, 40%.
Okay. Now, we're kind of running out of time.
Yes.
But we have some questions on benefits, and then we also have, maybe before we leave the brackets again, there's a question of, we have scenarios where you consolidate one's income for tax filing, they exceed certain brackets. How can one account for the extra, yet the deductions were already made? I don't know if that makes
I
sense
think
to you.
that was the same question I answered earlier, where I said in a particular month you might exceed your bracket, and yet in the whole year you're not going to exceed that particular bracket. Another part that I said can apply for refunds if you exceed for that particular month and you're taxed in a different bracket, but it was only because of some allowance that happened that month, and yet ordinarily you're in a lower bracket and you, by the end of the year, you wouldn't have exceeded your bracket, then whatever extra was charged for that particular month, at the end of the year, when we are sure how much you've earned in total, you can apply for a refund of that excess that you paid.
Okay. So now the benefits. The
Okay.
questions had car benefit
Okay.
and then accommodation. Again, I think that particular time we had the schools and as well the medical people.
Yes.
I'll just read out, quote the one on the medical staff first.
Yes.
How do you treat the medical staff who are required to stay within the hospital overnight to handle patient emergencies
Yes.
in the night if they are provided accommodation within the hospital for that purpose?
Okay.
That's accommodation. And there was one on car benefit. The computation, the devaluation every financial year, and does it also reach a point where it becomes zero?
Okay. So I'll start with accommodation. Now, accommodation is a benefit that some employers give to their employees. If you come to work for a particular company, especially executive jobs, you work for a particular company, they'll pay school fees for your children, they'll give you a maid at home, they'll give you a chef, they'll give you a house, and so many of those benefits that come to people in that high level. Now, when it comes to accommodation, it's got to be a house, first of all, that you live in with your family, that you can use for your own purposes. If I give you a room to sleep here in URA because there's something that you're doing that necessitates you to be here, yes, then that is not an accommodation benefit because you're doing it for purposes of work. You're staying here for purposes of work. It's not a home that I'm giving you and saving you the rent that you would have paid. So that is not an accommodation benefit. So yes, doctors sleeping in hospitals because they are on 24-hour call, no, that is not an accommodation benefit. An accommodation benefit is a house for your private use where you live ordinarily with your family, not just some room that someone has given you, or those tents that, you know, people use for people that are working in hard to reach areas. No, that would not be an accommodation benefit. So it has to be a house that is available to you for your private use to live in with your family. That is when it becomes an accommodation benefit. Now, I know there are instances where people will say the company is on a particular building and then the top floors are apartments. Now, that is different. That's an apartment. It's a whole house for private use. You find that even your wife and your children are up there living in your home while you're down here working. That is accommodation. An accommodation benefit because you would have paid rent to house and accommodate them, but you're being given a house at the top floor. So we should be able to distinguish between those two. This person is staying in the hospital for purposes of working. You can't bring your wife and your child to stay with you in the hospital. Well, this one has a whole fully furnished apartment on the top level of just the building that they use for work. Those are two different things. That will be an accommodation benefit, while hospital would definitely not be an accommodation benefit.
Okay. Then the
last one, car benefit. Yes. Now, car benefit, the person asked about how we compute it. And unfortunately for computations, there are things that have to happen practically. You're not going to just out of nowhere start to explain a computation. So what I try to do is come up with an example of how a typical motor vehicle benefit will be computed. So let's say you the benefit, first of all, comes in when you have a car that is available to you to use for your private purposes. Okay, if you have a car, like right now, you can call up the fleet office and say, I need to go somewhere and do some work for URA. That is not a car that is available to you for private use, okay? Because you simply need it to get to where you're going, maybe a meeting with a client, maybe you need to visit a taxpayer's premises. That is not a car benefit. But if you have a car that you use daily to go to work, to come to work and go back home, you can even use it to pick your children from school, that is available to some executives. That is when we start to compute a motor vehicle benefit. You must be able to use it for private purposes. But if you can only use it when you're at work to visit a client's premises, they bring you back, you go back to your desk, that is not a benefit for starters. So how does the law say we compute it? There's a formula for computing it, and that formula is available in the law. I don't know if a person who asked the question is able to view this, but the formula looks at how many days that car is available to you to use for your private purposes, the cost of the car, And of course, it also looks at depreciating that car every year, because a car is a depreciable asset. The car that you got in 2024 when it is brand new is not going to be the same car three years down the road. It would have lost value. Even if they were to sell it, they wouldn't be able to sell it at the same price. So the law looks at the valuation of that car at each particular year and depreciates it. So I think that's why the person said something about devaluation. So the formula, which is 20% of A times B over C minus D, looks at A being the vehicle, market value of the vehicle, that is how much was paid for the vehicle. Then B, looking at the number of days that you have it available to you in a particular year. And then C looks at the number of the days in a whole year, of course, which is 365 days. And then D means any payment that you make towards that car, because some people or some jobs will give you the car and then ask you to also pay towards it. Okay, they'll say, okay, we're buying you this brand new Toyota Prado. Maybe it's worth 600 million, but every month you have to make a particular payment towards it because you're using it. So if you make a particular payment, then of course we have to take that into consideration. Because remember, at the end of the day, okay, because this car is a benefit that is given to you, you've got to pay tax on that benefit. So meaning what you're going to take home at the end of the month is going to be less by the tax that you paid for that car. So if you are earning a salary of, let's say, 20 million, but you have a car, after they remove the pay as you earn and they remove the car benefit, you're going to have much less money. So if you contribute towards it, we have to take that into account so that we don't reduce your money much more than it should have been. So how do we compute it? I gave an example. You have Jen. She's an MD in a particular company. She's given a double cabin. If you could just go back. Yes, given a double cabin. And let's say we are looking at the year 2019, because the person wants to see how you depreciate this car across the years. So you're given the car on 1st October 2019 as part of your benefits. The car was bought at 185 million and it's available to Jane whenever she needs it, meaning she can use it to go home, use it to pick her children, use it over the weekend. So we need to know how much she's going to pay in terms of taxes for that benefit for the year 2020, because remember 1st October means you're in financial year 2019-2020, and for the next year 2021. Why it's important is because she's got it in the middle of the year 2019-2020. So we need to understand how you compute when someone gets the benefit in the middle of the year or when someone has had it for the whole year. So if we can just move to the computation. Okay, so in the first year, she got it on 1st October. Our formula is 20% times A times B over C minus D. So in 2019-2020, when she first got the car, she had it from October. So she had it October, November, December, January, February, March, April, May, June. So she had it for a total of 9 months. So that is why you say we're going to say 20% times 185 million, which is the cost of the car, times, we added up all the days she had it for 9 months. That's why you see there's 31 plus 30 plus 31 plus 31 plus 28, of course 28 being February. So you add up all the days that she had it during the year and divide by total days in the year, which is 365 days. So you will find that in that particular year, the benefit that she got for that particular car would amount to 27,673,000. So how do we then determine her monthly benefit? The monthly benefit is you simply get the yearly benefit and divide it by the number of months for which she had it. Okay, so that means the benefit is now for each month 2.7. Now, if you had it for the whole year, because in the year 2020-2021, she's had it for the whole year, then you might have to add up all the 365 days. But remember, she's now had it for a year, and the law says depreciated by 35%. So right now, we're going to add 185 million times 65%, because we need to remove the 35% depreciation rate that was given by the law. So we're not going to determine the value of the car to be the entire 185 million. It has lost value. It's no longer worth 185 million. So we're going to take only 65% of the value of the car, which was 185 million. So our new value is 65% of 185 million. And now we're not going to add up the months because she's had it for a whole year. So it's 365 days over 365 days. The benefit for that particular year will be 24,050,000 because she has had it for a whole year. We divide that for the 12 months and the benefit for each month will be 2,040,000. 4,167 shillings.
Okay.
I know that I might have gone through it very fast, but also typically this is something that you need someone to explain to you. Maybe a webinar would not be the perfect place to explain a computation, but that is how we determine it. It is laid out in the law. We devalue or depreciate the car every year for at a rate of 35%. So yes, after a certain period of time, the rate will be zero.
Okay.
Yes.
All right. So just a few questions before we go. Omagor Nicholas asked about the car value benefit, and I think you've got that.
Yes.
And then we have Aban, who's saying, I'll just read quote unquote, please comment on life insurance for employees working for exempt organizations. This has been a challenge in NGOs where there have been several arguments. One, life insurance is paid directly to an external party and not to employees. And two, employees cease to be covered on life insurance when they leave the organization. The benefit is only realized on death while still working for the organization. For time, I think this will be the last we can answer. And then the rest, we can always have them another time.
Another webinar. I think it's going to be a point where you just go to the YouTube and respond to the comments as they come in.
Yeah.
So yes, insurance. Okay, so yes, employers in some organization will provide you with life insurance, which is paid to you at the end of your contract if you have a contract with them. Now, life insurance comes in different forms, okay? So probably the person is also not very clear. Life insurance comes in different forms. For some life insurance covers, it's just a fixed amount of money that is due at the point when you either die or when you retire, or even after a particular period of time. It can even be 3 years, or 6 years, or 10 years. So it depends on what you've agreed upon with your employer and how much that insurance company is willing to give in terms of the latitude that they can give you, if they can give you life insurance that covers only a particular period of time, or if they can give you life insurance that is restricted to when you die or when you get a medical emergency. So do we tax life insurance, or do we tax any insurance for that matter? If it is for the benefit of the employee and it is paid upon a particular circumstances being death of that person, or paid when that person gets a medical emergency, so no, that is not going to be taxed, okay? And that is why you see when it comes to medical insurance, that is not taxed as a benefit, because it is looked at something that may or may not happen, and it's a benefit that is given to you dependent on a particular set of circumstances. Now, what about instances where it's like a savings scheme but looked at as life insurance, where someone is paying, let's say, I want to get 100 million, okay? That is what is agreed between the employee and the employer. By the end of this contract, I want to have obtained 100 million, and the insurance company computes it for you under life insurance and says, okay, if you want to get 100 million, we're going to give you, let's say, you're going to have to deposit this much. Okay, so at by end of 3 years or 6 years, or whatever you've agreed, you have 100 million. Now, that particular benefit is a benefit to the employee that is determined. And for that, you might have to include it in your employment income, because it is determined, it's a set amount of money. It's not upon your death or anything. It's like a savings scheme. So there's got to be a difference between what you're calling life insurance. So I think that question needs to be a little clearer. Maybe the person can explain in the comment section, then we can give the particular laws and determine how much the life insurance would be and whether it is taxable or not.
Okay. Thank you so much, Jelly. We've, I think, really exceeded our time.
Yes.
Just parting shots, and then we can sign out.
Okay, thank you so much for hosting me, and thank you to everyone that is viewing this particular webinar, and thank you for tuning in and for being interested in tax and tax matters and enhancing your tax knowledge. And we ask that for any topics that you are not particularly clear on, you can just send them in so that we can be able to hold much more of these webinars. And please spread the knowledge that you're able to get so that more people out there can know something about URA, and we don't have a lot of instances where people lack knowledge and are coming from a point of ignorance. Otherwise, until next time, have a great day.
All right. Thank you so much, like just said. And for those who are asking about where to get the recordings, these are posted on YouTube, and you can get them there. Thank you for joining us, and be blessed.